Hey, Eric here from 5minuteinvesting.com and welcome to my channel. So in this video, we're going to talk about whether you should exit when the market crashes. And in 2020, the market has crashed, dropped quite a bit because of the coronavirus panic. Now, I previously did a 4-video series on the coronavirus, so if you haven't looked at that, you can definitely check it out. And now I want to talk about the psychology, because I know that a lot of investors are panicking, a lot of people are exiting and holding cash, investing in gold, so on and so forth. Now, of course, the pandemic has been spreading quite quickly, so it is only reasonable for people to panic, especially if you don't have a financial background. So to determine what you want to do during this market crash, the first thing you need to figure out is what kind of investor you are. So in this video, we're going to cover 3 main types of investors. The first one is ETF investors who invest regularly. The second one is ETF investors who invest occasionally with some cash piled up. And the third one is investors who like to pick stocks and now they're in the red. And there's also a fourth type of investor, which is investors that have not invested, but they have cash piled up. So we wouldn't cover the fourth type in this video, and we'll be focusing on the first 3. So let's say you are an investor, ETF investor who invests regularly. So let's say you're contributing $500 or even $1,000 a month to an ETF every month or every quarter or so. So if that's the case, you don't really need to change your strategy, because when the market is going up, you want to invest regularly, so then you're averaging up, your average cost is increasing. And when the market is down, this is actually a good opportunity for you to put money into the market, and then you get a lower and lower average cost. So then when the market recovers, then you will be in a much better position than before. So that is quite straightforward, right? What you need to do. But the tricky part is to overcome the psychology and the fear that it's apocalypse and nothing will continue and everything will die. So it's more like a mental game instead of what you need to do, because what you need to do as an ETF investor who invests monthly or quarterly is actually very simple. So let's say you're an ETF investor who invests occasionally and you have some cash piled up. Now, the most unfortunate version is probably you invested just before the market crash, so early 2020, because you saw that 2019 had some great returns, and now you want to jump in and capture some of that return, and end up you got burned because of the market crash. Now, what's important here is if you have cash piled up, it is a great opportunity to enter and lower your cost. And one of the key questions you're going to have is, how do you figure out the crash is ending? How do you figure out it is the bottom? And regardless of how many YouTube videos you watch, regardless of how many articles you read on the internet, even if you follow Warren Buffett, there's no way you can truly predict the exact bottom. And coming to this realization now, or you can come to this realization through hundreds of backtests, will save you a lot of pain, is to realize that nobody can truly predict the bottom. So then you should develop a strategy with the assumption that you cannot predict the bottom. So then the question here is, well, if the market is going down, let's say it went down by 50%, what are you going to do? Are you not going to invest a single dollar? If the market went down by 60%, what are you going to do? Are you not going to invest a single dollar, or are you going to start investing a little bit? And I think is that balance between how much you're investing, depending on how much the market is down, will put you at a great advantage because you have cash piled up. Now, one of the key questions a lot of investors have right now is, if I entered at a high, which is just before the crash, should I exit my portfolio? And I think that is a very valid question, and that is where a lot of people will make their mistake. Now, I know there's a lot of fear in the markets, especially North America right now, because there's the entire panic going on and everyone is staying home, people are getting laid off and so on. So it only makes sense that people want to hold on to cash, which is why the market is slumping. So if you are a smart investor and you believe you cannot time the market, if you take money out right now what are you going to do? It's important to think about the second step. If you exit your losses right now and you don't have an investment to put it back into and you're just holding cash, that means you are trying to time the bottom. And with the market dropping already 40, 50, some 60%, how confident are you in terms of timing the bottom? So if the market is end up assuming it's going to drop 70%, how confident are you that you're going to get 70% instead of 60? Because for some stocks, it has already dropped 60%. And if it is going to drop a little bit more, the difference between 60 to 70% is actually not that much. So you as a long-term investor, this is a fantastic opportunity for you to enter, assuming you know that you cannot predict the bottom. And if you exit your losses right now, you'll just be going back into the market. So the difference is not even that much. So the third type is actually investors who are picking stocks and now they're in the red because they invested before the market crash. Now, for ETF investors, it is kind of straightforward because when you invest in an ETF, you give up the control of picking a stock. You invest in a basket of stocks, you let a mutual fund manager do the stock picking for you, and it has very low management fee, and you get your 6-7% or whatnot every single year, but now you're in the red. So if you decide to pick stocks, which I think it's a great idea, then what you're really evaluating is, A, do you expect the crash to continue? Now, if you ask some people are going to say that, oh, it's not over yet, it's going to keep going, it's going to keep dropping and dropping and dropping. And if you ask somebody else, for example, like me, then I'll be like, well, it has already dropped so much, like 50, 60%. What do you expect? Do you expect that the market will drop 80 to 90%? If so, what do you think is the likelihood of that happening? And if you don't think the market will drop 80, 90%, and right now it dropped 60 already, then aren't you pretty close to the bottom? And if so, then it's pretty obvious what you need to do. So then if you have some stocks that is already in the red, then what you need to do is actually just switch that into stocks based on the following criteria. The first one is, what do you think is the risk of that company going bankrupt? And, you know, when the market is going up, everything is rosy, everything is great, you know, companies is making more money and so on. Demand is increasing. And even if a company is poorly ran, it will be performing okay during the market uptrend. But when the market is going down, this is when companies run out of cash. This is when the bank call on their loans, and that is when they go bankrupt. So the most important thing when you're investing during a market crash is to understand whether the company will go bankrupt or not. And this is usually done by looking at their financial statements. That's a whole separate topic. And you should evaluate the risk of the company going bankrupt. If you are holding onto a company that you think will go bankrupt and you bought at the high, then you should pretty much just exit it. Because yes, there's a possibility that it won't go bankrupt, but if the bankruptcy risk is too high, then it might not be worth it anymore, and you'll lose your entire stake when investing in the market. Now, the second criteria is really, is there a better investment opportunity? So the market crash has happened, period, and here you are now. So you're holding on to these basket of goods, or stocks in this case, and you're looking at the markets to see if there is something better that you can switch into. So for example, let's say you're holding on to a stock that is, generating a low revenue growth and is heavily impacted by the market crash. But then you see another stock that you think it's going to grow much faster after the crash is over. Then if that is the case, then it makes sense for you to exit this stock that you're holding and invest in the other stock. So I think if you follow these two criteria, then it's pretty straightforward in terms of what you need to do during a recession time. And if you're a long-term investor, then what you should think is actually not to be too short-term. You want to focus long-term, because when you focus on a short-term, the next day, next week, next month, next 3 months, that's where all the fear is. If we look 12 months ahead, then you're going to realize, well, it's not going to be as bad as today. And if you think that, 12 months from now is going to be as bad as today, then obviously you are predicting a very, very deep crash, great recession kind of crash, which may happen and nobody knows. But in my opinion, that likelihood is especially low. So I think I will bet that the crash will recover faster than what most people expected. So if you are an ETF investor, then that is even simpler. You just hold on to your holdings and you just keep putting money in as the market is going down on a regular basis. And if you are trying to time the ETF, then what you're really trying to do is to time S&P 500. Then what you're really trying to do is to time the bottom. Now, if you just remember, nobody can truly time the bottom, but sometimes you might be able to get really close, and just getting close to the bottom is probably good enough in most cases. So that's pretty much it. My name is Seto, and my mission is really to help people without a financial background to master investing and target 30% a year using an hour a week through an online coaching program called Investing Accelerator. So if you want to learn more, you can click the link below to watch a free webinar called How to Get 30% from the Market. So I packed a lot of value in this webinar, and it kind of outlines my approach on investing and how I invest during the market crash as well. So I think you will enjoy it, and let me know if you have any questions, and I'll see you in the next video.